Hello, welcome to Newscentre. With me, Parikshit Luthra. The top story this evening: multiple brokerages have tempered their GDP growth expectations after India reported a slower than expected growth rate of 13.5% in the first quarter, while Moody's has cut its growth estimate from 8.8% earlier to 7.7%. Citi, Morgan Stanley and a few more have trimmed their outlook. But Union Finance Secretary T.V. Somanathan remains upbeat about achieving an annual growth rate of over 7%. He also ruled out adjustments to the FY23 borrowing target, adding that the government will achieve its fiscal target this year. I'm now joined by Steve Cochrane, Chief Economist of the Asia-Pacific region at Moody's Analytics, Devendra Pant, who is Chief Economist at India Ratings and Research. With us also is Hughes, the CEO at Cohesion Investments. Thank you very much for joining us. Steve, if I can begin with you, how do you see the GDP numbers coming from India? Most analysts have said that the growth is likely to slow down due to the sliding base effect as well. Give us the factors that could be challenging for India in the next few quarters.
Well, you're right that the GDP figures for the last quarter were a bit disappointing, not quite what we expected. And the distribution of growth across the economy was rather uneven as well. This is one of the problems, I think, facing the Indian economy right now. When you looked at the GDP report, the strongest growth came from the public sector, from government spending, and output from manufacturing and from agriculture was really rather weak. So one of the difficulties facing the Indian economy is really just getting back to kind of a balanced pattern of growth where all sectors are contributing to growth. The other problem, of course, is the high inflation rate, currently at 6.7, and that will weigh on the economy as well. Ultimately, even if consumer demand is rebounding from the pandemic downturn, if inflation stays high, that will be a bit of a weight on the economy as well. And finally, I think the trade balance needs some correction. The trade balance is negative and getting worse. Exports have been much slower than have been imports. And that import bill, of course, will depend a lot on the price of energy and imported food commodities and such. So a lot of imbalance in the economy, kind of a mixed bag. I think that's the best way to describe the economy right now.
Right. Devendra Pant, to get you in, we're looking at a slowdown in many of India's key allies, many of India's trading partners. How do you think this is going to impact India's export growth story in the months to come?
Well, Parikshit, exports story is because if you look at last year, I'll go back in FY22. Most of the exports growth which we had seen was price driven, or rather than the volume driven. Barring few sectors, most of it benefited from the price. So as the commodity prices started correcting, India import a lot of crude oil, export a lot of petroleum products. Those things have started coming down. So that's what we have been seeing. Even the first quarter, the export growth has been relatively weaker than what the import growth has been. And going forward in rest of this fiscal year, or maybe till the prices, those economies stabilize, we are going to see a slowdown in export from where we are right now, and the import will continue to remain high because of our high dependence on oil, imported other oil, that is imported edible oil, imported pulses. And last but not the least, right now we are looking at the coal imports. So what we are looking at, like the current account deficit, which if you look at the balancing item or the last two terms in the GDP identity, which is X minus M. So we are expecting the current account deficit in this fiscal to rise to 3.2% of the GDP. So this means that's a negative number in GDP, and that is pulling down entire GDP growth. We were, 13.5 was surprise for many. Our estimate for first quarter was 13.3. And looking at the numbers flashing on your screen, so our full year forecast for FY23 was 7%. Now, is it going to change? So we have to look at the internals, how the individual how the consumption is behaving, and how investment is behaving, and most importantly, how the entire monsoon is behaving, because we had seen in the latest data that monsoon pattern over Gangetic plains, which are mainly the rice producing areas or the paddy production, there we have seen a deficient rainfall. And if you look at from the acreage numbers, we are seeing the area under paddy has gone down compared to 6 to 7% lower than what it was last year. So what kind of impact it is? First round of impact through the production, second round of impact through the inflation.
All right. Of course, we'll have to watch these factors in the weeks to come. But to get in Spike Hughes at this Spike, which are the sectors which make you optimistic about India right now? Going forward, inflation is a major concern, and this is what policymakers will be deliberating over very closely. What are the areas, sectors, which make you most confident about India?
So, I mean, in terms of sectors, Parikshit, I think, the great thing about India is it's so diverse. There are many sectors that are very, very attractive. But I think, one sector in particular that looks very attractive is pharma. We can't look at pharma as a single sector because there's many subsets. It's not cyclical. There's always a bull run in certain parts. But, the size of the pharma market for India, what we've seen in recent months is it's been quite tough with high crude prices, raw base material costs have increased, the derivatives refined from crude oil, etc. The supply chain disruption have put margin pressure on this sector. But nevertheless, the upside, the valuations look very attractive, and the upside for growth within subsets of this sector look very, very big. So that's one industry sector that I think looks very positive outlook.
Right. Let me get in Steve once again. Steve, how do you think India is likely to perform compared to other economies in the Southeast Asian region and among other emerging economies?
Well, in some ways, India has a lot of advantages, at least in terms of avoiding some of the risks that other emerging market economies are facing right now. You can see that in the currency, at least over the last couple of months. The rupee has been fairly stable, finally. India is actually less export dependent than are some of the smaller emerging market countries as well. So some of the exposure to at least the European economy, which is the area that's most likely perhaps to fall into recession, might hit India less than others. Government debt is high at about 75% of GDP, but very little of that is in foreign currency, and so there's a little risk of that of the government being able to manage the debt load going forward. So, given the breadth of the economy, the dynamism of the economy, and a little bit less exposure to some of those foreign risks, I think India actually looks like it should be performing better than other comparable emerging markets in South Asia or elsewhere in the world.
Right. Devendra, Pant, we have been reading reports about how the slowdown in China, especially in the Chinese construction sector, could benefit India. To what extent can that happen?
So the Chinese construction sector slowdown, if that, or for that matter, any big economy, which is a large consumer of commodities across the globe, and if that goes into slowdown, so the immediate impact which is felt is the price correction. So the raw material and intermediate goods which are consumed generally will have a lower prices. So what we had seen is whenever the global economy goes into slowdown or in the recession, we see all commodity prices correcting. Now, direct one-to-one Chinese construction collapse. So basically, the cement demand, but we hardly imports cement. But the steel demand globally will fall or will decline, but that too, the long products, not so much on the flat products. The flat products demand is more dependent on how the car demand is shaping or how the other FMCG product, say for example, refrigerator, also others are behaving. So if there is collapse of Chinese construction sector, the immediate impact will be felt on the steel long product pricing, and which steel prices, if you look at, are all base metal pack in last year has run up too much. And though there is some correction in those prices also, but when you look on yearly basis, on YOY basis, there will be some impact. Still, there will be some impact. So this is what we can see. If the Chinese construction sector is slowing down, the demand for those commodities across the globe will slow down, and there may be some correction in the prices, and India will be beneficial in all those products which we are importing out, those long products. But there will be few companies at the micro level here, those who will be exporting those products, so they will be negatively impacted.
Right. Spike, to get you in, as far as companies like yours go, which sectors would you like to invest in, or what are some of the global cues? What are some of the cues that global investors are looking at when they see the Indian market currently?
So I think what's been interesting, historically for the last few years, global investors have looked at the US. It just went up and up and up and up for 10 years and 12 years even, as that very, very long bull market. And of course, a lot of that was fueled by QE. And then what we've seen this year in 2022 is obviously, well, if we look at it, to the end of August, from January, the US market is down quite meaningfully, and the Indian market is up a bit. And I think the thing that has really come through this year has just been the resilience. You couldn't have thrown more at India than it's seen in the last couple of years with COVID, and then the crisis with Russia-Ukraine this year, high oil prices, foreign investors selling, and yet we've seen tremendous resilience both in the economy, as the still pretty much the fastest growing major economy with the best outlook, the only economy in the world that can add trillions and trillions and trillions of dollars in the next few years. The stock market has been much more resilient than pretty much every market this year. As I said, it's gone up, whereas most markets have gone down. And even the currency, yes, the dollar has appreciated, the dollar index, quite extreme appreciation against everything in the world. But when we look at the rupee, it's been much, much stronger and more resilient, for example, compared to the pound or compared to the euro or to the Japanese yen. So for me, from a big picture perspective, this is time for foreign investors to say, this is the most exciting economy in the world. We should have a meaningful allocation to this, because there's no country in the world that can put the growth on that India can generate in the next few years. And that's something that foreign investors should definitely take exposure to. And when I look at the West today, where's the growth? It's very hard to see the growth.
Right. Steve, as you were pointing out, and many other analysts have also said, that India is in a better position than other economies. And there is, of course, the possibility of a global recession that people are also talking about. What are some of the cues, some of the areas that India must keep in mind, focus on very closely over the next few months if it has to manage this slowdown?
Well, one of the important things, I think, is helping to keep the pace of bank lending growing. Bank lending actually hasn't been very rapid, and it could slow further if interest rates stay high, particularly if the RBI raises interest rates further. And given that many small to medium-sized enterprises need financing to expand coming out of the tough year last year, I think it's going to be very, very important to keep liquidity expanding and allow credit to expand across small and medium-sized enterprises. And then agricultural production, as mentioned earlier, has been very questionable, and anything that can be done to help support agricultural production, I think, will be very, very valuable.
Right. Mr. Pant, just to come to you now, in terms of global investments, global companies moving to India, we have been reading how Apple recently shifted part production of its iPhone model, the latest iPhone model, to India. How will global companies see this? Do you see more manufacturers shifting to India because of geopolitical situation, because of the situation in China?
Well, Parikshit, the answer is yes and no. Basically, what has happened is post the global economy has a lot of dependence on China, and as we all know, every enterprise want to distribute their risk. They don't want to have concentration to one particular sector or one particular economies. And post U.S.-Chinese trade relation issues, the global manufacturers started looking at China +1. Now, in that situation, which is that +1? So for some of that investment has gone to Cambodia, some of them has gone to Taiwan or Philippines, some of them is coming to India. So what an investor is looking when they are having a manufacturing base in the economy. So the typical ease of doing business, how the infrastructure is, how the employable or employability or the technical skills of the labor, how good or bad is power supply situation depending upon the large scale manufacturing, how good or bad is the country's laws in relation to all those issues related to contract implementation and all those. Based on that, the manufacturer takes investor takes a decision. Generally, what they look at, another point, is stability of the policies. So if the policies are policy flip-flop, there's too much policy flip-flop, policies are changing abruptly, because if it is well known that India is a relatively high tax economy compared to the others. So if an investor is shifting its base to India, it is taking a decision based on that information that it's a highly taxed country compared to the others, but it gives you certain advantages. You can serve or provide goods and services to a large domestic population, and you can set up it as a base to export to the other parts of the world, or maybe to the Asia and Africa. Now, if there are frequent policy changes, retrospective policy changes, then that is not good from the investment attraction point of view. We have improved a lot on ease of doing business, but we haven't seen commensurate increase in FDI. Because what we have seen, most of the flows are coming in the form of portfolio investment, but not that much, or the FDI inflow hasn't increased in the same proportion. So what we are looking at, a stability of policy that will help investors to understand or to gauge the problem, to estimate the issues, and post that they take their own informed decision. But the informed decisions are taken on the basis of policy, a policy set of A, B, C, but maybe after some time, you have the policy set of X, Y, Z. So that's the issue.
Right. Okay, we've run out of time, but Devendra, Pant, Steve Cochrane and Spike Hughes, thank you very much for joining us on Newscentre, analysing the GDP numbers and the factors that India must keep in mind while managing the economy over the next few months. We're going to take a short break, but coming up, catastrophic floods ravage Pakistan, with the country reporting over 1,200 deaths. More than 33 million people have been affected. A conversation with the renowned Pakistani journalist Hamid Mir once we're back.